credit amounts to 30% of the qualified purchases, up to $1,500 credit. This is the total credit you can take for years 2009 and 2010. You do not get the $1,500 for both years. It is a combined total. As I said, it must be your primary residence. Get the documents when you purchase the equipment. Be careful on this one too. Not all Energy Star rated equipment qualifies. There are some very technical guidelines. Ask the people you are purchasing from for a certificate that says this is in fact qualified. They must be installed by the end of 2010 to qualify. Okay, everyone hear of alternative minimum tax? Very large tax. The cause of AMT kicking in to effect on your tax return. If you have large unreimbursed business expenses, if you have ISOs, incentive stock options, high state income or real estate taxes, large families with lots of deductions, large miscellaneous deductions, very high medical expenses. Those types of things cause the AMT, the alternative minimum tax, to kick in. You will then be taxed at a flat rate of either 26 or 28%. The child tax credits. Child tax credit is $1,000 per child. It is non-refundable except for some low-income earners. The child or children must be under the age of 17. The phase-out starts at $75,000 and $110,000 for married filing joint. There is an adoption credit out there. It is up to $13,170. That $13,170 will be in full if you are for certain handicapped or disabled children if you do adopt them. Child care, 20 to 35% of $3,000 for one child, or up to $6,000, 20 to 30% or 35% of $6,000 for two or more children. This is for children in daycare. Summer camps may apply. The child care credit does not apply to things that are improving mental skills. So band camps, special tutoring, anything that is for a scholastic purpose does not apply for the child care credit.
Do sports camps?
Do sports camps apply? No, they do not.
They do not.
They do not. I've got my support group here. So. Okay, some basic planning rules. You can control your income and your deductions. There's something called bunching deductions. What you can do is pay, because we pay for last year for our property taxes in this year. What you can do is prepay your taxes if you're just getting over the itemized deduction amount. So pay for 2 years of real estate taxes in 1 year. That's a good way to bring it up. Plan your charitable giving to do it 2 years worth in 1 year. Bring up your charitable deductions. Buying and selling stocks. Take your capital losses to the extent of gains plus $3,000. You are allowed to deduct an additional $3,000 per year of capital losses. Otherwise, you have carryovers if you go over that $3,000 amount. If you're wondering where you're at with those, obviously call your broker or go to your fund's website for the proper amounts for capital gains. Take advantage of the 0% rate. Good idea, again, gifting to qualified people in lower tax brackets. You're allowed to gift, with no reporting purposes, $13,000 to each person that you wish. You can do that to as many people as you wish. The $13,000 is very useful in cases of transferring things like appreciated stock, where you would be taxed at the 15% rate. Maybe an elder parent or someone would be taxed at the 0% capital gains. For 2010, there is no estate tax. For any of you worth a lot of money, beware of your children through the end of the year. Very, very dangerous time right now, because the estate tax will be coming back into play in 2011. Both the Republicans and the Democrats have said they want to increase the estate tax or exclusion amount. It should be coming back in at somewhere between $3.5 million to $5 million for 2011. If Congress does not act due to the warring between the two parties, it will revert to $1 million. Now that's very easy to hit if you have some life insurance, some equity in your home, some basic investments, your retirement account. So be real careful with that if they do not pass that. Consider taking capital gains in the current year at 15%. If we do not get an extension of the Bush tax cuts, the capital gains rate will be jumping to 20% in 2011.
When are we going to know that?
When Congress acts or fails to act. Yeah, exactly. This has been making our planning real challenging.
Do you call up Walter Bean in session yet?
Yeah, our lame duck session where we've got two groups that are absolutely at war with each other.
Let's show with one more.
Just for an update on that, for those of you who are interested, President Obama has come out and said that he is willing to compromise. He was pushing before for keeping the middle income tax brackets and lower at the Bush tax cut era rates and only raising the taxes on the high income earners. The Republicans, feeling very strong after these elections, are trying to push that they make these tax cuts permanent. Obama is only looking for 1 to 2 years of continuation for the higher income tax brackets. Once again, business purchase equipment. It is deductible under 179 for $500,000 if the total purchases are less than $2 million, and there is an additional first-year bonus depreciation of 50% on new equipment, regardless of the total purchase. For charitable contributions, in 2007, they really jacked up the requirements of documentation that you must have. For under $250 charitable contribution, your canceled check or your credit card receipt will be adequate for the IRS for audit purposes. Anything over $250, you have to have the charity provide you with a document stating that you have made that contribution. A lot of people used to just donate cash and put that on the receipts, that on their tax return. That is no longer something you can do. You will lose the deduction if you give cash and do not have a letter from the charity. So all those Salvation Army times, you drop the $5 in the bucket, add it up at the end of the year, put it on your return, the IRS will not allow that anymore. Good advice for charitable contributions. Contribute appreciated stock. You get the full value of the stock on contribution. You never want to contribute stock that has declined in value. It is better to sell it, take the loss on your personal, and then donate the money. If you're a business owner in a C corporation, consider paying out dividends. Dividends are taxed currently at the 15% rate. Seeing that we don't know what's coming in the future, much better to get them out at the 15% rate. In your book, we have information on retirement, pages 16 through 20. There's the IRA out there. It qualifies for a regular tax deduction for AGI. The contribution limit is $5,000 plus $1,000 if you are age 50 or over. You can look in your book. There's the income limitations for everyone. Roth contributions are also $5,000 plus $1,000 if you're over 50. Unlike the IRA contributions, Roth contributions are done with post-tax dollars. They are not tax deductible. But the advantage is you can then receive the money when you start taking it out tax-free, including the amount you have earned or any capital appreciation on those assets. Any money that you put into a Roth IRA, you can take out the principal without any tax consequences. The earnings, you need to be either 59.5, or if you put them in or they need to be in there for 5 years, whichever is greater. So you need to either be 59.5, or if you contributed at 57, you need to be 62 to start getting those earnings out. Watch your tax brackets. If you're trying to determine between an IRA and a Roth IRA, an IRA you want to contribute to if you are in a higher income tax bracket now. It will lower your taxable income currently. If in retirement you think you are going to have lower income. If in retirement you think there's a chance of having higher income, you may consider a Roth contribution, because those are not deductible now but are not taxed later. So the Roth is a better move if you are going to be in a higher income tax bracket in retirement. For those over 70.5, you must take a distribution known as an RMD, which is a required minimum distribution. This does not apply to Roth accounts, but applies to your IRAs and other retirement accounts. Most banks and brokerage firms are letting you know what your RMD should be, but be proactive. If you do not make your required minimum distribution for the year, there is a penalty of 50% of the underpayment, the under-withdrawal amount. Just for an approximate rule of thumb, your RMD is about 4% of the account balance. Penalty-free withdrawals from IRAs, there are some exceptions. You can get money out of the IRA before 59.5 if you need to. Normally, withdrawals before 59.5 are subject not only to ordinary income tax, but also to a 10% penalty. The exceptions to this: medical expenses over 7.5%. Oh, I'm running over. First-time home buyer up to $10,000. Higher education costs from an IRA. Health insurance for the unemployed. And if you structure it in substantially equal periodic payments. We have IRA conversions to Roths. They have taken the income limit thresholds away. So anyone with an IRA now can roll it over into a Roth. You have to pay the tax on the full amount of the rollover now, and you do not want to use the IRA dollars to pay that tax. If you're under the 59.5, you will be subject to the 10% penalty and ordinary income tax on the money you used to pay. For that conversion, you can choose either to pay the tax now or in 2011 and 2012. Have some more information for you. There's all kinds of tax stuff going on, but I have a feeling everyone wants to get back to work and is probably getting bored of listening to me ramble on. Yeah. For those of us who don't want to get back to work, we can stick around and ask any questions or go over anything that was unclear. Thank you very much for your time, everyone. Thank you.
Thank you so much, Brian. Excellent presentation.